the stock's value increased by like $10 billion in the first 10 days or $50 billion in the first 10 days of the mergers. But because the companies stuck with the model through 2008, they added another 500 billion.
My name is Mike Mauceli, and this is the Energy Show with REI Energy, where we're energizing your investments and maximizing your tax deductions. Today, you're going to discover oil investing in 2025 and beyond. You're going to discover what the future trends are in oil and gas investing from one of the most experienced and successful oil analysts. My guest today is Doug Terreson. Doug is a former head of energy research at Evercore ISI and Morgan Stanley. Great to have you on the show today, Doug. Well, Doug, thank you for coming on the show today.
You're welcome. Thanks for having me.
So I hear you got a new book out called Can't Deny It. Can you tell us a little bit about it?
I do. The book is called, Can't Deny It. Oh, I might have messed that up. But anyway, the book's called Can't Deny It. And we published it in November. It's done pretty well. It started off as just really kind of a collection of stories that have been at kind of the center of the oil industry over the past couple of years, but I guess it's a memoir too. But it really kind of goes to why and how I became this person who was at the epicenter of a lot of these major events over the past couple of decades, and how it influenced the kind of how the industry has been in shape to the degree that it did. And really kind of also talks about how a person like myself from Mississippi who didn't really know exactly what he wanted to do in high school kind of gravitated towards the oil industry, and how it worked out in kind of a fantastic way. It's an industry that I love, as I know you do as well, and I'm happy to see that it's prospered over the past couple of decades. And I think it's in a pretty good place to prosper going forward too.
Yeah, well, I know you have a lot of experience in the oil and gas industry, and as far as that, and I know you tell a lot of good stories. In fact, I'm gonna I'm gonna get a copy of the book. I was looking at it this morning, and as soon as we get off of this podcast today, I think it'll be a great read. And I know you tell some pretty interesting stories in it. You got one you want to share with us?
Sure, we've got more than one. So the book really has five or six different stories, and my background is petroleum engineer, Mississippi State. I've drilled hundreds of wells for Schlumberger out in the deep water Gulf of Mexico and onshore as well. So I kind of learned the oil industry from the ground up, and that was hugely beneficial to me once I went from being an engineer to being an analyst on Wall Street. In that most of the guys that I competed with had degrees in finance or business or what have you. But I knew the industry like the back of my hand because I spent a lot of time on oil rigs over the years. And so anyway, I show up at Morgan Stanley in the late 1990s, and within 3 years of me showing up there, I had become the number one oil analyst on Wall Street, according to the Institutional Investor Poll, which is just this poll that surveys really two-thirds of the money that's managed around the world. And I said, well, maybe it's pretty clear that investors are reading my research around the world. Maybe I should use my platform to try and affect change in the industry. And you may go, well, why do we need change? Well, in the late 1990s, S&P Energy had gone from 28% of S&P 500 in 1980 to 14% in 1990 to 4% by 1998. And my view was that unless the companies changed their direction, it could go to 1 to 2% of S&P 500, which means that the stocks would just continue to go down. And so I worked on my report, which was hopefully going to affect change for a year. And I kept it to 8 pages because I wanted everybody in the industry to read it. And the report was called The Era of the Supermajor, which is where the phrase supermajor came from. I mean, supermajor wasn't a phrase really until that report. And basically what we suggested in that report was that the industry has had business models that were basically dysfunctional at best and probably obsolete at worst, and we needed to change. Well, coming up with the problem in an industry is easy. Coming up with the solution is a little bit more difficult. And so at that time, we basically proposed that these major companies like Amoco and Texaco and Chevron and what have you needed to combine and create what we called supermajors. And you may say, well, what would that do? Well, we thought that companies that had similar corporate cultures, similar quality assets, similar functional and geographical diversification, once combined, would kind of become companies that would dominate the competitively advantaged investment opportunity set going forward, and they'd have superior returns and superior valuation, and the stocks would go up, and we'd all live happily ever after. Well, you can imagine that if a 36-year-old comes out with an industry viewpoint that's completely oppositional
Yeah.
to that which was being employed by the rest of the companies weren't going to be too happy with me. Investors weren't going to be too happy with me either, because I basically said that unless they change course, energy stocks are going to continue to decline further. And then the FTC probably didn't love me that much either, when you start to consider that I was calling for the most significant restructure of the oil industry going back to the breakup of the Standard Oil Trust in 1911. But what we found out, Mike, shortly thereafter, was that the buy side, the investment community, really embraced my thesis. The media, specifically The Economist, the Wall Street Journal, and the Financial Times did as well. And even though I was marketing this concept heavily, um, the buy side and the media kind of started doing the work for me. Anyway, within 6 months, BP and Amoco merged. It was the largest merger in the history of Wall Street at the time, $50 billion. And what mattered about that combination was that BP paid a 25% premium for Amoco, and their stock went up. And so basically what that said was that this model is the correct model. And if companies don't subscribe to it, they could be left out of one of the most significant transformation in the energy sector. And so sure enough, within 3 or 4 months, Exxon and Mobil announced their combination. It was the biggest merger in the history of Wall Street at the time. Their stocks went up as well. And then they fell like dominoes, Mike. We saw Chevron and Texaco and Elf Total, Fina and YPF, Repsol and Conoco and Phillips, and I'm probably leaving somebody out. But what mattered in the aftermath of the mergers was that the stock's value increased by like $10 billion in the first 10 days, or $50 billion in the first 10 days of the mergers. But because the companies stuck with the model through 2008, they added another 500 billion. And so S&P Energy, which had gone from 28% of S&P 500 in 1980 to 14% in 1990 to 4% by 1998, had risen to 14% of the overall market by 2008. It was the best move maybe in the history of the whole energy sector. And the reason why was because companies were embracing the value-based models. They were doing things that were aligned with shareholders. And energy was the best performing group in S&P 500 during that phase. So we're going to call that, mission accomplished. It was a fantastic period, that is between 1998 and 2008, for the energy sector, led to great prosperity. And it was just a fabulous time. And by the end, after the stocks had gone up as much as they had, Morgan Stanley, because it was effectively our concept, and was then invited to be involved in all these different privatizations around the world. And so we were involved with basically the restructuring and privatization of the Chinese oil industry, and so we took Sinopec public, which is now the fourth largest company in the world. Did the same with Norway and Statoil, which is now Equinor. We took ConocoPhillips public. You may say, well, what's the big deal? Well, it was the biggest U.S. IPO at the time. And then we tried, really hard, Mike, with PDVSA in Venezuela, which is another story that's in the book that's, pretty interesting. And so anyway, it was a great phase, and because it was, kind of our, concept, and because everything, kind of came to fruition all at once,
No,
it
it's
led to great
definitely
prosperity in the sector.
changed the industry. Do you see further consolidation or not?
Well, so we've had a lot of consolidation, and if you if you move to the current phase, the industry, really after 2008, really kind of lost their way a little bit and started to invest tons and tons of capital in relation to what they were distributing to shareholders. By 2016, S&P Energy had gone from 14% of S&P 500 in 2008 to probably about 5 or 6% in 2016. And our view is that by 2020, S&P Energy was going to go to 2% of the overall market, which wouldn't have been good. And so we came up with another idea called the Pledge for Greater Capital Discipline and Enhanced Corporate Governance. And because the industry, really adopted the value-based model all over again, we saw, really strong prosperity. And to your question, because a lot of, the companies that didn't have the competitively advantaged investment opportunity set to be competitive, we did see a lot of combinations. And so we have had a lot of combinations. And the reason that that's good is because we now have fewer companies. They're all investing capital in a way that's beneficial to shareholders. And so there's probably going to be some more consolidation. But, as a board member of Phillips 66, I kind of look around the industry and there's just really not that many major players left. But the players that are left, whether it's, Exxon or Chevron or ConocoPhillips, all of which are very astutely managed, in my opinion. I think the management teams at those companies are outstanding, not only absolute but relative to history, are just positioned in really solid way today, I think.
Yeah. No, I
So,
agree with you. I mean, the companies today seem to be, much better operators, and
yeah,
a lot of that has to do with the consolidation, even between the independents and stuff. So you bring in some really good talent. And
yeah,
so, what are the trends that you see for oil and gas in 2025?
yeah. Well, so I think when you have to start with the global economy because oil demand is the function of income or GDP and how high prices are. And the global economy looks to be in pretty steady Eddie mode. I mean, when you look at the IMF's projections for global GDP growth, I think that they're assuming that global GDP is going to rise by around 3%. And sure enough, the IEA translate that into better demand growth. And global oil demand growth grew by about 850,000 barrels per day in 2024. And even though there's lots of calls for peak oil demand and deceleration and what have you, it's not going to happen in 2025. Oil demand growth is going to accelerate. We think to about 1.1 million barrels per day, or at least the IEA thinks to around 1.1 million barrels per day. And so that's a pretty healthy condition to work from. Now, after having said that, when you think about the supply side, yes, it's true that the U.S., which has accommodated 100% of global oil demand growth during the past decade, is going to see deceleration. But there's growth elsewhere in non-OPEC, whether it's Brazil or Guyana or what have you. And so for that reason, OPEC has basically come out and said that they're going to postpone unwinding the production arrangement they've had over the last couple of years, at least until March of 2025. And that's a good thing because even with strong demand growth this year, it looks to us as if, or if you just use the IEA's numbers, as if demand or supply growth or supply is going to be over demand and inventories are going to build by six or 700,000 barrels per day this year, which tells me that the Brent price of around $75 per barrel today is about where it should be. Now, you may say, okay, well, tell me something that we don't know. There's almost always going to be some geopolitical effects, and I think that the ones that people are pointing to the most right now are, how is the Trump administration going to handle Iran? You may remember back in 2018, once the sanctions hit, Iran's production went from 4 to 2 million barrels per day, plus or minus. And so obviously, if we lose a couple of million barrels per day of production from Iran, that's going to completely change the calculus for the inventory builds. And who knows what's going to happen with Venezuela? There's been some disruption down there over the past couple of weeks as well that bears watching. So if you take the kind of the steady Eddie, assuming that there aren't any lightning bolts from the blue scenario from a geopolitical perspective, it looks to us as if inventories are going to build modestly in 2025. And in that scenario, kind of 75 to 80 looks like the right price. But Mike, we know something's going to happen. We just don't know what it's going to be.
Yeah. Well, I know we get a lot of oil out of Canada, and of course, when Biden came in, he killed the leg of the Keystone pipeline that was going to run down to Texas, and uh, and that had a kind of an immediate effect on oil and gas prices. I don't know for sure if that was the major cause, as far as with the Keystone pipeline, but you see a lot of the shale plays today. A lot of them are maturing, and I
Mhm.
don't see how you can, when and I understand we want to bring oil prices down, but I don't see how they can come much lower because simply the cost of drilling these horizontal wells and just the acreage costs alone of
Yeah,
basically leasing the land and stuff. So I think you have to have prices somewhere in that $60 to $70 range for
yeah.
WTI.
So, Mike, I think that's true over the medium term, but I think what we learned in 2014 was, prices can go below the equilibrium
Yeah,
level. but it's unlikely that they're going to stay there for an extended period of time. Meaning, when I think about the oil market, the downside is going to be set by the marginal cost to produce, and maybe from the shale players or some other players that will reduce production when prices go below cash cost. And you also obviously have to consider OPEC's budgetary needs. So that's the lower end of the bound over kind of the medium term period. I think the upper end of the bound is when is oil too expensive um, for the consumer, meaning at what point has the price become too high where the consumer cuts back on his spending on oil and gas. We're a long way away from that. I mean, traditionally the consumer has spent between 3 and 9% of his income on energy. We're at the lower end of that band, and so I guess what I would say is that even in a scenario where we see an extra 2 million barrels per day of oil come back onto the market related to Iran or what have you, and the price declines, could we go below 50? Absolutely. Would we stay there for an extended period of time? Probably not, just like we didn't stay there for an extended period of time in 2015, 16, and 17. We will have a recovery. It just may take a little while.
So when you look, that's great on oil. When you look at natural gas, of course, we
Mhm.
have a tremendous amount of natural gas. It's a byproduct of most oil wells that are being drilled. In fact, we have so much of it. A lot of times, you have to pay to get them to take the gas. As far
Right.
as that, I mean, is there a way to use more natural gas here in the United States where people can actually afford to drill it and produce it?
Yeah, so I mean this cold weather that you're having in Texas and we're having in Alabama is certainly helping, but that's seasonal too, and
Right.
so that certainly doesn't hurt. But when you think about demand for energy really over the next several years, it's really pretty pretty good. It's really likely to be pretty good. Meaning when you think about all the power demand that we're going to see from all the AI that the data centers, I mean, I think it's going to be something for everybody. I mean, it's not just going to be natural gas. I mean, I don't know if you've been paying attention to the coal stocks, but the coal stocks were pretty good last year too, and that's an area that's basically been abandoned by Wall Street. There's not much coverage, and so I think that for this reason, and again, there's been a lot of discussion about how demand for power is going to increase. It bodes well for U.S. natural gas. It also bodes well for coal to some degree. And then, of course, these gigantic LNG projects that are under construction on the Gulf Coast they're going to take some gas away as well. So yeah, I think you can be constructive on the outlook for natural gas over the next couple of years, um,
I think these
and
small
really for those
nuclear,
reasons.
I think these small nuclear reactors are going to play a part as well. I went to a talk, I guess Governor Abbott had a couple of weeks ago, and of course he was saying that Texas A&M now runs all their universities off of these small nuclear reactors, and so you're going to see a lot more of that here,
Yeah.
especially in Texas.
Well, I mean, that makes a lot of sense, and I'm a little, surprised with how advanced nuclear technology is and how it's used so much, in the military that it hasn't evolved faster. But at the same time, when you think about, what type of energy sources are going to accommodate this demand for power that we're going to see in the United States over the next couple of years, there's no question that it'll make a contribution, but it may be latter in the phase as opposed to earlier in the phase. And so earlier in the phase, what does it come down to? Well, there's going to be some renewables that make some contributions, obviously, because there's growth there. But I think it makes a pretty positive case for natural gas. And again, coal demand for coal just keeps rising too, just like it does for oil. It seems like peak demand for all these fossil fuels just keeps getting pushed out. So
I want to ask you a question. I don't know if you know much about it or not, but one of the things that Governor Abbott talked about was, Texas is going to have its own stock exchange here next year in 2025. I wanted to know your thoughts on that. I mean, one of the things that he said, it's going to basically, if a lot of the Wall Street firms turned against oil and gas, but this Texas stock market is going to help companies in the energy industry,
mhm.
become public if they want to. So I just wanted to get your thoughts if you knew much about that.
Well, yeah, I have heard about it, but I also think that this a lot of the firms that have kind of pushed back on fossil fuels have kind of done so at their own expense. And quite frankly, that phase reminded me of the dot-com bubble in 2000, in that effectively what was happening around 2000 when I think this clean energy bubble probably had its peak. I mean, it's not going to go away. We're going to continue to see growth. There's no question about that. But at that time, it was a period when clean energy stocks were trading at 50 times earnings, which compared to S&P 500 at 15, and traditional energy at 8 times earnings. And so there was a lot of enthusiasm, I think, towards a lot of those clean energy companies. And we talk about this in the book, Can't Deny It. And there wasn't very much enthusiasm at all towards traditional energy, and that caused the cost of capital to rise in the energy sector. And it also caused the energy stocks to do very poorly. But fortunately for us, and we talk about this in the book, we think that the bottom for traditional energy was around November 9th of 2020, which is when we officially upgraded the group. Obviously, it's had a fantastic move since then. And it also looks like that was about 30 or 40 days before the peak in the clean energy stocks, which have completely collapsed. And
Yeah.
so I guess what I would say, Mike, is that this idea that something besides returns will set valuation in the stock market, meaning that other non-financial factors are going to set valuation and share prices in the market, I think is kind of fallen by the wayside. I'm not sure it's subscribed to, but it's cost a lot of people a lot of money along the way. So I don't
So,
I don't know if we're going to have our own stock market in Texas or not, but I think that there's been a lot of lessons learned about that phase, and there's been a lot of money lost in clean energy, and a lot of money made in traditional energy along the way.
yeah, you do see a lot of the majors starting to pull away from it, as far as that, and I would assume that's one of the reasons why we have such high electrical costs here in the United States, because we've subsidized a lot of this green energy that just isn't profitable.
Well, I think that there was this viewpoint that there would be a green premium for a lot of these stocks in the market. And I think what valuation theory would tell us is that the market doesn't care so much which industry you're investing in. What it does care is that you're creating economic value, and if so, you'll get paid for it. And the converse is true as well. If you're in an industry, and again, I don't care if it's tractors or the internet or clean energy or whatever, you're going to be held accountable for your returns in the market and the value that you're creating, and your valuation will be assigned to your company accordingly. And so if you're creating economic value, more power to you. You'll experience a positive outcome in the market. And if you're not, you won't. And I think the market's really indifferent as to how companies create economic value. If you do, you get rewarded, and if you don't, you get punished. And I think that too is a lesson of the last 3 to 5 years in the energy sector.
I wanted to kind of talk a little bit about, DEI in the oil and gas industry. Obviously, we see some of the examples of it now starting to take hold in these places that, like the wildfires out in California, where people just aren't prepared because they were more interested in hiring, you know, meeting a quota as opposed to hiring people that actually knew how to manage stuff. And did we see a lot of that in the oil and gas industry over the last several years?
I mean, I can't really speak to all the things that have happened in California.
Yeah.
Just because I don't think I know the facts at this point. I mean, it's only happened over the last couple of days. But what I would say, in general, really for any industry is that the companies that tend to perform best have the best players on the field. And I don't really care if it's the technology sector or the financial sector or the energy sector. You have to have better players than your competitors, or you'll eventually pay for it. And so, whether some of the hiring practices in the energy sector or the other sector were based on merit or not, it's kind of a broad topic, and it's kind of hard for me to say. But just like the points that we made a few minutes ago about corporate strategy and capital management and whether or not companies are creating economic value, human capital is a really important part of
Yeah,
the equation. It just,
I agree with you.
and you're competing with really astute competitors every day, and so you have to get it right. So I'm not going to really speak to the DEI part of it, just because it's kind of hard for me to to answer that. But I do know that it matters whether or not you have qualified personnel everywhere, and I think our industry does a good job at that.
So you talked a little bit earlier about that you were on the board of Phillips 66. I know they, are closing down a refinery in California, and I guess a lot of people are going to obviously lose their jobs out there. And I mean, how does California? I mean, do you see the political climate changing in California for oil and gas, or is it going to continue to push towards this green energy?
Well, I think California is clearly pushing towards green energy. There's no two ways about that. And and listen, green energy has benefits. I mean, we're all environmentalists to
Right.
some degree. I mean, we all want clean water and clean air, and I think different people have different views as to how to get there. But typically, Mike, when you see refineries close, it's because they've been pushed off the cost curve, meaning that their plants are really old. They're not cost competitive, and and so for that reason, as in my previous life as a buy side and sell side investor, a lot of times companies get tired of losing money, and their shareholders are even more tired of them losing money. And so for that reason, you have to shuffle the deck every
Yeah,
you have to shuffle the deck every now and then,
but we
and
don't have that many refineries here in the United States, do we?
no, no, we've got a decent amount. I mean,
Oh, do we?
uh, yeah, no, we're pretty self-sufficient on refined products in North America. What you may be thinking is that we're not building a lot more
Right.
refineries in the United States, and the reality is that we're not building a lot more refineries around the world. So you may say, well, wait a minute, if demands for crude oil and refined products are continuing to grow, and we're not building more processing capacity, isn't that kind of a precursor to having prosperity? And the answer is probably so. And I think for that reason, the Wall Street research is pretty constructive on that space.
Yeah, I don't know where all of this is going. I know a lot of our refineries originally were designed to handle Venezuelan crude, right? And of course, now with the government changes that they've had down there, and it looks like it's going to continue, that I'm not so sure how much oil we're going to get from Venezuela in the future.
Yeah. So, Mike, it's unfortunate, and can't deny it. In my book, there's a part about privatizations, and specifically Venezuela. And in 1998, myself and a fellow by the name of Tom Langford, another guy by the name of Doug McKenzie, made a presentation to the board of PDVSA, and we were investment bankers at Morgan Stanley at the time. I was a research analyst; they were investment bankers, and we basically said we can privatize 1/3 of PDVSA, which is the national oil company of Venezuela, and pay off all the debt of the government of Venezuela. And you may say, "Oh my gosh, that's a no-brainer." If you think about that, then Venezuela could have built a sovereign wealth fund much larger than the one that Norway has, which is the largest in the world at $2 trillion. Unfortunately, that was right around the time that 1998 specifically, that Chavez came into power. Investment bankers like ourselves were not welcome any longer in the country, and they employed policies during the next couple of decades that completely trashed their economy. They've lost a third of their population, Mike,
Yeah.
and that's why we are where we are today. And so, rather than having a $2 trillion sovereign wealth fund like Norway has, or an even larger one, the Venezuelans have $150 billion of debt that's in default, and it's really unfortunate for their people, for sure. And so hopefully there'll be positive change down there. But these these governments seem to know how to stay in power, just like the Castros did for a really long period of time. But it's been really hard for the people of Venezuela, and the standard of living and the quality of life. It's really been
Yeah,
unfortunate.
no, I
So
agree. I
so,
agree.
Mike, we can hope for change, but this has been going on for a long time.
Yeah, well, doesn't look like much is going to happen now since they uh, you hope that it is, but obviously, you look at the political climate and stuff, and it's kind of difficult to see that changes. But when you
Yeah.
look at places like the Middle East, I mean, obviously there's a lot of turmoil going on over there. I mean, how is that going to impact the oil industry?
Well, I mean, I think that they're really pretty rational players. I mean, when you think about oil, during the past 10 years, growth in shale production accommodated 100% of global oil demand growth. And you may say, well, what's the point? Well, we can't do that for the next 10 years. I mean, if you look at the IEA's numbers, production growth, which was like 17% 5 years ago, 17% annually, is going to be 1 to 2%. And some people think it's going to be zero or negative this year. And so the question becomes, okay, well, if the United States can accommodate global oil demand growth, who can? Well, it kind of leaves Iran, Iraq, Saudi Arabia, UAE, Russia. Guyana is going to make a contribution. Brazil. There's probably going to be some oil supply growth in West Africa. But at the end of the day, what this sets up for is a very different mechanism by which oil demand becomes accommodated during the next decade. So we're going to be counting on countries that we have, somewhat mediocre relationships with in some cases, but other countries that we have pretty good relationships with. And so I think that we can count on the Saudis and the Emiratis to do their part. What's happened in the Middle East really during the past 20, 25 years has just been remarkable. I remember, the first time that I went to Qatar in like 1998 and Kuwait and some of those places, and now it's like night and day, and they're just really thriving and prosperous, and they want the same things that we do, Mike. They want a better quality of life, and they want stability, and they want an improved standard of living for their people, because that usually keeps politicians in power. Last time I checked.
Yeah. Well, it hadn't done very well in Iran, I guess, but
Right.
places like that. But hopefully that'll change in the future.
Well, that too would seem to be would be a positive outcome for a lot of people in the Middle East, and who knows, maybe we're at an historic juncture.
Yeah.
But the Middle East has really changed a lot over the last 20 years. I mean, the development over there has been unbelievable, but there are still some guys that are stirring the pot, and the only reason that the oil price hasn't risen more, I think, is because we have so much spare capacity today that the market's basically saying, so what if we have an outage in one of those countries, because we've got enough spare capacity to cover it, and so therefore I'll get too excited in the price of oil.
Well, Doug, it was sure great to have you on the show today. Can you tell our listeners how to get a copy of your book?
Yeah, sure. So the book is called Can't Deny It, and you can buy it on Amazon or Barnes and Noble. And I think that there'll probably be a lot of people, Mike, in the industry, such as yourself, and investors and other people too, who will find shades of their journey in mine. I think you'll remember a lot of the stories, and hopefully you'll find it entertaining. But we're really happy with the feedback, and people seem to like it. And so anyway, you can find it on Amazon.
Great. Well, like I said, it was great having you on. I'd love to have you back in the future.
Thanks a lot, Mike. I really enjoyed speaking with you.
This podcast is a presentation of Rich Dad Media Network.